Hi, good morning. My name is Andrew Hellman. I'm an attorney with the law firm Murray, Plumb Murray, and I'm delighted to be here with you today with David Jean from Albin, Randall Bennett and my colleague Katie Krakoka for a webinar presentation that we're calling Weathering the Storm, CARES Act Relief and Cash Management Strategies for Small Businesses. Why don't we advance to the next slide, and we'll just give you a brief introduction of who we are, and then we'll run through the overview of the problem that we want to help you address and some of the high-level goals before we turn to the detailed content. David?
Hi, Andrew. Thank you. Privileged to be here today, and really thank everybody for attending. We're really excited to share some of our insights in terms of how we can help businesses better improve their cash flow, especially during these difficult times. I'm a principal at the firm of Albin, Randall Bennett. We're a CPA firm based in Portland, Maine, and we provide accounting, tax, and consulting services to a wide range of businesses throughout New England. And again, thank you very much for being here today. Katie?
Hi, I'm Katie Krakoka. I'm an attorney at Murray, Plumb Murray in Portland, Maine. And I'm a commercial attorney who helps my clients not only with specific legal problems and transactions, but mostly what I do is I advise business clients through complex problems and help them simplify it and come up with a plan. And I hope that that's what you'll get out of today's presentation.
And again, as I said, I'm Andrew Hellman. I'm the co-chair of the Business Reorganization and Restructuring Group at Murray, Plumb Murray, and I work with all types of businesses as they navigate distress situations. That includes everything from business advice and legal advice to even going so far as kind of formal court cases such as a Chapter 11 reorganization. So let me tell you what the overview of the problem is as I see it. We have an uncertain health circumstance due to COVID-19, and we have what appears to be a clear economic disruption for an extended period of time. The president of and CEO of the Federal Reserve Bank for Minneapolis was in the news earlier in the week saying that his projection was 18 months of potential economic disruption, really until such time as we have widespread therapeutics, widespread testing, and a vaccine. So while I expect that we will all start to return to more normalized economic activity, many schools may be closed through the end of the year, and that will impact economic productivity. And human behavior may change for a period of time. And so what we want to do, and our goals are to help you have some of the tools that you need for short-term and medium-term planning, and to give you a framework to develop long-term plans. And the tools for short-term and medium-term planning, like budgeting tools and operational changes and new sources of value from new money and tax credits, will help to support long-term and the medium and the short-term business planning. So with that as the framework to the problem that we want to help you solve and the goals for the time that we have together today, what I want to do now is hand the mic over to David, who's going to talk about the immediate short-term, what we mean by short-term in this program, and then the tools that we have to help you figure out what you need to do. David?
Great. Thank you, Andrew. So I just want to spend a few minutes talking about some of the short-term action strategies that businesses can employ to help with cash management, accelerating cash flow. And when I think of the short-term, I really think within a 90-day period. So that's sort of how I'm thinking in terms of what a short-term action strategy is. And I think that some of the things that businesses can start doing is certainly start with reducing discretionary expenses. Really identify those expenses that are necessary and those that are discretionary that can be delayed or forgone. Accelerating business billings and accelerating cash collections is vitally important. And for those businesses that perhaps, let's say they typically bill on a weekly basis, maybe we go to daily billing. Maybe we bill upon the delivery of goods and services. And in terms of managing cash collections, really important to have an open communication with your customers. So if you are seeing some delayed payments, pick up the phone, contact them, try to understand the current situation, offer payment terms, deferments, and really work with them so that there's some expectations of cash collections, so they'll help you better prepare your budgeting in the future.
David, sorry, as you're talking about these short-term issues, what's the specific time frame that you're looking at? I didn't mean to interrupt you, but if I'm the business owner and I'm looking at are these things that I should be trying to implement right now? And if so, what's your best recommendation for how long they might be necessary right now? Again, sorry to interrupt you there.
No, thank you. No, thank you. No, I think when I think of short term, I think of really now. These are immediate actions that company has to take now, particularly if they're trying to get through the next 30, 60 days with all the uncertainty that's taking place in the economy. So I think these are actions that should have been started taking place yesterday. So thank you. And, supply chain alternatives, I think it's important to make sure that if you're having difficulty getting goods and services from your current vendors and supply chains, I'm making sure that you have options for others in case that things are held up. And we don't want to delay your ability to deliver those goods and services on a timely basis. That's going to affect, obviously, cash flow. Vendor payment arrangements, I know Andrew's going to talk a little bit more, and Katie a little bit about later in terms of how you address those arrangements with your vendors. Loan deferments, the FDIC is really encouraging banks to defer payments. So a lot of banks are providing 2-3 month deferments of principal. Basically, they're just going to put those deferred payments on the back end of the loans. So that's something that you can do immediately, which will result in immediate cash flow savings. Establishing or expanding a line of credit. If you don't have a line of credit, I suggest you establish one with your current bank. And if you have an existing line of credit, even though you don't expect it to be fully utilized, maybe a good idea just to be somewhat proactive and increase in case you do need it. And I think one of the concerns I have in terms of the lines of credit is, I'm concerned about waiver of default. So if you're going to be nearing your renewal date, and let's say that you have some financial covenants based on working capital, debt ratios, tangible net worth, you may be in violation of those debt covenants. So you want to have that conversation with your bank prior to the renewal period in case your line of credit may get frozen or possibly not renewed. So it's important to look at your documents, see what the covenants are, and have that conversation with your bank. Inventory reduction, that's a lot of cash that's sitting on your shelves. Is there opportunities to perhaps return some excess materials to your vendors, perhaps maybe subject to a restocking fee? I got clients that are now looking to try to sell excess materials on eBay. So there's a lot of creative strategies out there to try to move some of the inventory. Review business interruption insurance. Some policies may have coverage for this, others don't. So it's important that you talk to your insurance agent to see if you do have coverage. And probably the most important thing really is to manage your cash flow, manage it tightly. And really what we strongly recommend is really using a 13-week rolling cash flow forecast. Essentially, this is a spreadsheet that you can use, a tool that you can use, that you can monitor your cash receipts each week, what you have for necessary disbursements, and what you anticipate for cash receipts. And again, I'd be conservative on the cash receipt side. It's a good opportunity to reach out to your customers, find out exactly what you anticipate for cash receipts, that you can budget accordingly. So on a week-by-week basis, you can identify what cash shortfalls you have, and if you do, how are you going to meet that shortfall?
Hey, David, on that cash receipts piece, that's really important. So we look at 13-week cash projections all the time in the restructuring work that I do. And my clients often benefit from talking to folks like you about how to figure out what percentage of cash receipts are reasonably likely to come in. Do you have any suggestions for business owners for how they can evaluate that when they're looking at their AR and their work in progress to make kind of a reasonable guess? Or have you started to see any drop-offs with clients that give you any rules of thumb, or is it still too new and too uncertain? What are some of your thoughts there?
I think it's a great question. I think a lot of it depends really upon the industry. Some people, a starting point would be based on what your current historical cash flow has been, and typically, what's the average aging of your receivables. So I think that's really a starting point, or your base point is to look at history. But I think I would seriously start discounting that. And again, it depends on the industry. I've got some clients that are discounting their cash flow by 25%. So they feel that that is a conservative measure. Others are taking a more proactive approach and really reaching out to their major customers and really finding out what the expectations are and kind of build that into your model. So I think it's really on a case-by-case basis, but I think that by being conservative, you can never go wrong. So I think that's what I would suggest.
So one of the points that you just made there about reaching out to customers, I mean, that highlights a theme that I want to make sure that we're mentioning and that I was going to bring up later, is that, you know, we are all in this together and your suppliers are having similar problems, and a dialogue is a helpful thing. So that's a really good point that you make there, David. Yeah,
and you know, I think for all customers, for all businesses, we're a customer as well as a vendor. So I think you're absolutely right. I think that there's a lot of give and take, and based on my observations so far, everybody seems to be very much working together. But I think that by communicating, having an open dialogue, and being transparent with your customers and your vendors, I think will really go a long way into you know, all of us collectively getting through this. We've designed a cash flow spreadsheet that's available at our website. You're more than welcome to download that. We're going to have this presentation both on Murray's Plumb website as well as our website, so you'll be able to download the presentation, as well as we'll have a link to the spreadsheet. So again, I encourage you to check that out and see if it's a tool that could be helpful in your business.
David, can I ask a quick question? The thoughts you just had about how to project your cash flow sounded more tailored to a B2B type of client. How are you advising your B2C clients?
It's a great question. This is a little bit difficult, particularly, you know, if you've got some businesses that are non-essential services being closed down, then you're looking at minimal cash flow. So I think a lot of it depends on A, essential and non-essential, and B, you know, what kind of business to consumer type of business are you in? Are you providing credit to customers, or are you providing, you know, just cash or check at the time the goods and services are delivered? So it really varies on a case-by-case basis. But I think that by looking at what's happening over the past 4 weeks, seeing what's trending, and more importantly is what's happening to your industry, you know, your peers, your competitors, what are they experiencing? What are they doing? So I think there's some good data out there. And I think, again, just being very much aware of your customer behaviors at this point in time, I think that'll help you develop a good base to work from.
So to follow up on that, so I think of the cash flow analysis for the purposes of planning for the COVID situation as a little bit of a crystal ball. And, you know, how long are businesses supposed to project out the current impacts on their revenue into this 13-week cash flow? Have you given any guidance about that?
So what we suggest is on the 13-week cash flow, it's a rolling. So each week as you experience the actual results for that week, you essentially populate it and you go another week out. So by doing that, you can start to see what your historical trends have been for the past couple of weeks and incorporate that into the 13-week period. But it's really important that this is a dynamic exercise, not a static exercise. We are constantly updating the 13-week forecast. Now you go beyond 13 weeks and there's just too much variability. There's just too much uncertainty. So the further you go out, the more variability is on those figures. So by just focusing on a week-by-week basis and constantly monitoring and updating that so it rolls, that's really your best chance of trying to stay ahead of it.
David, could I just answer, just as a non-accountant, I think what you're saying is 13 weeks, that's 90 days. And based on my experience working with financial advisors and CPAs, when we get outside of a 90-day time period, certainty goes down and it's a little bit harder to predict and project. And so that's why we recommend a 90-day, 13-week time period. And I would expect that when a company is developing their 13-week cash projection, they would want to start with a period of time prior to the disruption so that they have a baseline set of estimates to use. And then they'll need to canvass customers, as you said, evaluate the market, or as Katie said, look into a crystal ball, but come up with some rule of thumb to apply a discount on projected cash receipts. And then also, we're going to talk about this later, a projected discount on disbursements to figure out how they're going to thread together over the next 90-day period. And that's, I think, the key point that I'm hearing you say, that you have to start with some certainty, pick a rule of thumb to apply, whether it's the crystal ball or you're talking to clients or both, and then project it out for 90 days. And when you say rolling, David, for folks who don't have a lot of experience with these cash projections, what I understand you to be meaning is that you might sit down every Monday morning and look at the actual receipts that came in from the prior week and the actual disbursements from the prior week, plug them in, and then stretch your projection out another week. So today, maybe we're looking out to, what would it be, July 6th or July 10th, 13 weeks out. And then come next Monday, we fill in the past week and we push out to the next week. Am I getting this right?
Yeah, you're absolutely right. That's exactly the way you would handle it, is, populate each week as it occurs. So again, you maintain that baseline so you can see what's trending, then continue to work out that 13-week period. So again, by looking at what's trending, that'll help you really kind of evaluate what you anticipate is going to happen the next week and the following week and so forth. So you're absolutely right. Thank you. So I just want to kind of turn our attention a little bit to some of the government financial relief programs that are currently out there, which does provide for some immediate liquidity. We have the Eid Loan program, the Emergency Injury Disaster Loan program. We have the PPP program and the FAME Loan program. So I just want to touch upon each of these programs. Even though the EID program is currently no longer processing applications, so what has been submitted, the applications will be processed on a first come, first served basis. But it's worth at least pointing out, in case it does get refunded, you certainly want to be queued up in that program if the funds do become eligible. So that particular program originates with the SBA. So you actually have to go directly to the SBA website to apply for that particular loan. So they have a web page specifically dedicated for that program. And the maximum amount is $2 million. There's a deferment option as well. This program is a little unique, is that you can get up to $10,000 in a tax-free grant. And once approved, that will be delivered in a few days. Even if the loan is not approved, you still keep the $10,000 tax-free grant. But if you do get approved, you don't necessarily have to draw from that loan to keep the $10,000 grant. A lot of folks have noticed that have applied for that, they're getting less than the $10,000. So it appears that they're adjusting those grants based on full-time equivalents or some sort of employment calculation. It's not clear to us. It's not on the website, but we're finding that a lot of folks are not getting the full $10,000.
David, I've had some communications with the SBA about that, and they're giving $1,000 per full-time equivalent.
So it's interesting. I appreciate you bringing that up. The Massachusetts District SBA had released some information that they were going to do the $1,000 per employee. That is now off their website. But it was funny because there's nothing that was in the SBA national website that had mentioned
Funny how that keeps happening.
But what's interesting about that is that what we thought, but we had some clients that had received less than the 10,000 that had more than 10 employees. So it's a bit of a head scratcher.
Yeah.
But yes, thank you. It's kind of unclear.
David and Katie, we received a question before the program on that. I wondered if you could ask and see whether this program would help the person. It was actually a landlord. There are a number of landlords who are having tenants who aren't able to pay residential property. And now some residential tenants will be able to get direct rental assistance from, I believe, from the Maine State Housing Authority. And landlords should tell their tenants about that so the tenants get the help they need, which will then allow the revenue to come to the landlord. But the $10,000 grant, Katie and David, that the two of you were talking about, does that, would that apply to a landlord? Would a landlord be able to access that $10,000 grant that you talked about, David, in conjunction with the FAME loan? Or is that only for businesses that have employees? And we may not know. I know there's a lot of uncertainty right now. We may not know the answer to that.
We've been asked that question for the clients that we've talked with. They've applied for it, but I have not heard anybody getting approved for that loan that had no employees. So it's unclear to me if you have to have at least one employee. Katie, have you heard anybody that has been approved for a loan that has no employees?
I haven't. I know that the eligibility requirements for the for applicants for the Paycheck Protection Program are different than the eligibility requirements for the economic disaster loans. And real estate plays a major portion. You know, how your business is structured around real estate plays a major portion in whether or not you're eligible for either program. So I do know that real estate developers are not eligible for the economic injury disaster loans, and nor are they eligible for the payroll protection loans. But real estate investment firms are eligible for the disaster loans. So I don't know how, because this keying on employees for the advance isn't written into any law anywhere. I don't know. They've made that up. So I don't work there, and so I don't know how they made it up. So I have no more clarity than that.
Well, that's a good point about making it up, and I think we all understand that Congress and state agencies are doing what they can to help support the economy, and it's a fast-moving situation. But look, I have several companies I'm representing in Chapter 11 right now that were already struggling, and they're having significant declines in their cash receipts. And the CARES Act, which is the federal legislation that established the Paycheck Protection Program, which is what I think David's going to move to next, there's no restriction on a company with 500 or fewer employees borrowing money under the program, even if the company is reorganizing in Chapter 11, but SBA won't approve any of those loans. So there's uncertainty and there's red tape. And I think that that's one of the reasons why the first recommendation that I have is to get your arms around your numbers with a 13-week cash projection so that you really have a handle on what you need right away. So Dave, with that, let me hand it back to you on the PPP loans.
Great, thank you. So a little on the PPP program, that does originate through a bank. So you have to go through a bank that is a authorized SBA lender. This is kind of an unusual program because there's no personal guarantees or collateral. The interest rate is 1% per annum up to 2 years, which is different than what the original bill had. The original bill had up to 10 years at 4%. So that was a change that was made in subsequent guidance. And as of yesterday, I believe it was yesterday morning, there was an announcement that the SBA is no longer currently accepting new applications because the funds have been, due to funding restraints. And it's unknown status of what the pending application that have been submitted. So even though they're not accepting applications, you know, with the pressure on Congress to expand the program, it could very well be an additional injection. There's been some discussion among some congressional folks that they want to put another maybe $250 billion into the program. So at this point in time, I'm recommending people don't count on it. You know, I would continue to operate your business as if those funds will not be made available, so that we're not necessarily relying on something that may not be available here. So, but it is worth certainly mentioning that if it is available, make sure you talk to your banker. You know, is the loan queued up? Where are you in the queue? And I think you just want to be prepared, again, if there's going to be some additional funding. But at this point in time, it's really difficult to know, but I wouldn't count on it. Real quickly, the eligibility is 500 or a few employees. There's some exceptions to that. If you're a franchise, there's certain types of businesses that if you have more than 500 employees, you are eligible. So it's important to talk to your banker or talk to your accountant to make sure you get some guidance on that. But essentially, the borrowing amount is 2.5 times your payroll costs. Payroll cost includes, among other things, gross payroll, includes health insurance costs paid by the employer, as well as retirement contributions paid by the employer and SUTA. And it's not to exceed $10 million. And the allowable use.
So as far as figuring out the borrowing amount, I know that the current opportunity for funding has closed, but this could come back again. I just want to throw out one quick legal consideration, which is this: the banks have been authorized to really rely on the information in the applications themselves. There are just trillions of dollars flowing out into the economy right now, and business owners should just be aware that at the back end of this, there is a potential for audit and investigation by the government. So you want to make sure that even though you're moving quickly, that you've got your numbers right and that you're asking for the right amount of money, not the wrong amount of money, because there's a risk that we can't fully quantify right now that the government will peek its nose in your tent later and make sure that loans were properly made. And that risk, I believe, may fall on the borrower, not the bank, because the banks have been authorized to rely on the information in the applications themselves. So I didn't mean to, I know you're moving on to forgiveness next, but I think that that's an important point for business owners to keep in mind, is that right now things are fast and furious. There will come a time when other people are looking over your shoulder, potentially.
Right. Yeah, what makes a lot of this really difficult is, the final regulations have been issued and we're waiting for those with the bated breath. So there's still a lot of, I know there's still a lot of questions that have been answered, even in the interpretations. It's sort of all across the board. So we're just kind of relying on what's been written in the bill, what the guidance is, and sort of some of the practical guidance that have been issued. But this could very well change. In terms of the allowable use of the proceeds, payroll costs is previously defined, interest, rent, utilities. Rent has not been defined. And does rent mean just rent on a facility, building? Does it include rent on equipment? Again, it's until we get further guidance, rent really hasn't defined. Utilities has been defined a little bit more, but even within the definition of utilities, they refer to as including transportation costs. I'm not sure what that means. That's quite ambiguous. So again, really anxious to see what the final regulations are going to say. And at least 75% of the loan for proceeds must be used for payroll costs. Again, the impetus behind this PPP program is really to retain employees. So they want to make sure that at least 75% of the use of the funds go to payroll and payroll-related costs.
David, for these two loans, the economic injury disaster loan and the payroll loan, how are employees define, full-time versus simply headcount? How do they split up on the definitions of those two loans?
Subject to interpretation. So when we get to the loan forgiveness calculation, in the bill, as it relates to the PPP program, it doesn't define an FTE, a full-time equivalent. However, if you look at the CARES Act, there are other provisions in the CARES Act that does refer to 30 people as a full-time equivalent. So we're taking the position that currently it's 30 people. Even though it's not expressly mentioned in this particular section, it is mentioned in other parts of the CARES Act bill. So again, until we get really further guidance, I don't know. But it's interesting because I've seen a couple of different, we subscribe, just like a lot of people, get inundated with emails from different sources. And on that particular topic, in terms of full-time equivalent, there were multiple sources that were using 40, others that were using 30. So.
Are you talking about hours?
Yes.
Hours worked, yeah.
Well, the good news, if I remember correctly, the good news is that there's no prepayment penalty. And so for those companies that have PPP loans that have been approved and cash disbursements have been made to you, it's worth taking a little bit of time to work through the loan forgiveness that David's talking about and we'll be talking about. And if you have the wrong amount, you can send it back,
right, so
that you don't have any amount that's above and beyond what's forgivable, or you can keep it and just, have a term loan. Yeah. And that's an important thing to understand, is that you're not stuck with the money if you don't want the obligation to repay it. You can send it back.
And in terms of planning opportunities, as you can well imagine, we're getting a lot of calls from clients to say, how can we best maximize the debt forgiveness? Can I prepay rent? Can I prepay utilities? How about, providing bonuses, within that eight week period? And quite honestly, in the guidance, they refer to as those eligible expenses that are paid and incurred, not paid or incurred. So that may sound like a subtle difference, but it's a very important difference because at this point in time, we don't know if the eligible cost in the 8-week period can be based on cash basis or accrual basis or a combination of both. So what I'm suggesting to people is make sure that we include all of those costs in that 8-week period. I'd rather ask for forgiveness than ask for permission. So do as much you can do within the 8-week period, even if it's an acceleration of expenses. Then when you go through the process of getting the loan forgiven, go through that calculation, then there may be some costs that get kicked out. But I'd rather be in that situation than trying to claw back expenses that were paid after the 8-week period. So it's really important to do your best to try to get as much of those expenses in the 8-week period. And again, until we get final regulations, I'm not sure exactly how that's going to shake out.
And is the analysis similar for past due amounts?
I'm sorry, what?
Would your analysis be similar for amounts that are past due as opposed to prepaying?
Yeah, exactly. So, because sometimes it's difficult to get an expense that's paid and accrued within the 8-week period, just because of the timing, the bill pay, and so forth. So, again, we're just waiting for further guidance, but at a minimum, in the meantime, again, try to track all those expenses in the 8-week period, even though they may end up being disallowed at a later point in time.
David, would the most prudent approach be for a company to proceed with whatever method of accounting it used before PPP? So if you were accrual, stick with it and don't make a change. If you're cash, stick with it and don't make a change. But either way, the advice here would be to track your expenses and track what you're doing.
It really is, and what I'm telling folks is don't try to in terms of what's forgivable, what expenses, what may not be forgivable. Let's not make that determination at that point in time. Make that determination in 2-3 months from this time. The other thing we're suggesting is that when you do get the PPP loan proceeds, put it into a separate account, segregate it so that you do have an audit trail. So essentially, when it comes to payroll, utilities, rent, then what I would suggest is that you use that account, transfer that money into the operating account and write checks out of that. So at least you have a clean trail. There's not a lot of commingling of funds. Again, the bill and the guidance doesn't specifically state that you have to segregate those funds, but I would rather err on being cautious as opposed to being under cautious. And at least you have an audit trail and you've been prudent in terms of how you've been spending those proceeds.
Well, that's also important to the extent that you have a lending relationship with a bank and you may owe the bank money. If you put the loan proceeds in a bank account at the bank that you owe money, that bank likely has set-off rights against all of your bank accounts. So if you borrow money from Bank A and Bank A is where you do your banking, you may actually want to put the loan proceeds at Bank B so that if you are in a default with Bank A doesn't have the ability to exercise set-off rights against that account. You may want to protect these loan proceeds and prevent them from being collateralized in that way.
Yeah, that's a great point. Just kind of a last slide on the PPP loans. If there's a reduction for amounts that are forgiven, if you reduce your headcount, your salary reduction during a specified period, there's some higher provisions that are unfortunately complicated and poorly written, that if you restore those individuals or restore that headcount and restore their wages, if there was any reduction of wages before June 30th, that you will essentially be treated as if, in other words, you won't get a reduction or penalty for the forgiveness of headcount and salary reduction if there's some restoration that happens before June 30th. And that is really one area where there's a lot of difference in interpretations in terms of those calculations. So again, we're eager to get those final regulations. If anyone's interested, at our website, we do have a detailed debt forgiveness worksheet that will help to calculate or estimate your potential debt forgiveness. And that worksheet is literally being updated on a daily basis as we receive additional guidance and interpretation. So I just want to point that out. The beautiful thing is the debt forgiveness is tax-free. What's going to happen by the state level, I don't know, but it'll be very on a state-by-state basis. So hopefully we'll get some better understanding of what the state's tax position is, hopefully sooner than later. The remaining balance, that is, yeah, go ahead.
That is just an important point about the debt forgiveness. So business owners should understand that debt forgiveness can often lead to what's called discharge of indebtedness income. And so there may be, this is a benefit to you. So the extent that the loan is forgiven, it's not a taxable event. That may be different from other agreements that you reach with creditors or vendors or other parties during this period of distress. And I think I just wanted to draw that counterpoint. Thanks, David.
Great.
And before we move on too quickly, can we recap just the short list of what we know about debt forgiveness under the PPP? So we know that you have to spend the forgivable amount of money within 8 weeks of receipt. We know that 75% of it has to be on payroll costs. We know that 25% can be spent on other expenses, but they have to be utilities, rent, or a mortgage obligation, a short defined list on obligations that were already in place as of February 15th.
Yeah.
We know that you have a head count requirement. Right now, that's as clear as mud about what that head count requirement is. And we really need guidance on that to be able to be any clearer. But if you've laid people off, you're probably going to have to bring them back on. And there's a wage reduction implication as well. And once again, we're going to need some more guidance on that.
Right.
Can I follow up on one point, the layoff point, Katie?
Mm-hmm.
So if I'm a business owner and I've laid people off and I've now got this loan, I have this question: do I keep the money and have it convert to a loan rather than a grant, or do I bring people on and pay them even if I don't need them? That's a fork in the road decision that business owners have at this point. Is that right?
You're absolutely right, and it's really going to be very on company by company basis. So we have clients that want to retain their workforce because they're concerned about, are they going to be available in 3 months from now, 2 months from now, even if they're idle. So for them, that's very important. And so that debt forgiveness is obviously is an incentive, and it's going to enable them to do that. However, we have other clients that are looking at that and saying, for viability, what's most important to me is working capital. Because if this does go beyond 8 weeks, what am I going to do? My line of credit's going to get maximized. I have no other sources or access to capital. What do I do? So it's anywhere in between. So they're really kind of two ends of the spectrum, and it really is going to be based on a really a company by company basis. And what's most important is what's most important for the business in the long term. And I think that is really the deciding factor in terms of what you want to do.
So there's a lot of questions that are coming up about this section, and I'm trying to incorporate some of them in the questions that I've been interjecting to you, David. But if you want to ask a question, just for the attendees, at the bottom of your webinar screen, you'll see two little bubbles that say Q&A. And if you click on that, you can type a question, and then I can try and incorporate it into the presentation.
And getting back to our point in terms of, do you retain or do you use that working capital? Having a working capital, loan for a 2-year period at 1%, that's pretty cheap money. So, so to some extent, they made this so attractive that it can always be seen as a disincentive to retain people because of the fact that you have a really low working line of credit. So I'm not sure it's had the impact that the government was hoping for in terms of retention of employees. So it'll be interesting to see how that shakes out.
Right, and especially given that unemployment benefits have been increased by, I think, $600 a week. So for some employers, the question is, do I keep the money for working capital purposes at this low cost of capital? Do I pay employees who might be idle to try to meet the policy purposes of the loan? And I think the question for you, and this is something we're going to talk about later, is it's a business risk decision ultimately.
Right.
But that's an important point. So sorry to derail you before you got to the FAME loan.
Nope, I was never on the reel to begin with. So, you brought up a good point. We've got a lot of clients that are saying their employees that come up to them and they're saying, can you please lay me off? Or I have concerns about coming back, even though I may not be directly impacted or affected with COVID. So some of these folks are getting more money on unemployment, particularly with that $600 additional stipend, that is sort of a disincentive to come back to work. And that's what some of our clients are dealing with. is need the staff, really don't want to come back to work, and they want to continue to collect unemployment for a period of time. So again, I don't think that was the intention of these programs, but these are some of the unintended consequences. And like anything else, you don't know what you're going to get until you start going through the process, and that's what we're seeing now.
Right. I think the question on the forgiveness piece for the kind of the headcount part is seeing clearly through the SBA regulations and guidance exactly when the snapshot of time they're comparing to. So, you know, I don't know if they are going to compare to immediately before the CARES Act was passed in terms of you need to make your headcounts match, or if it's during the same time last year, or how they're going to do that. We need the guidance on that so that if you have employees who don't want to come back, or if you made other employment changes throughout the year, you know, how does that factor into your forgiveness calculation in terms of meeting the headcount requirement?
So right now, our interpretation is that you look at the headcount and the reduction of wages between the date of February 15th and April 26th, which is essentially the date that's referred to as a covered period. So you compare that, presumably it's an average full-time equivalent on a weekly basis compared to what it existed at February 15th. That February 15th is an important date. So does that mean that at April 27th, you can lay everybody off and not get penalized? That's how we read it, that's how we interpret it. I don't know. And if you bring those people back on April the 29th and lay them back on July 1st, are you made whole? Well, it depends how you interpret the rules. So you're absolutely right. It's a landmine, and until we get some additional guidance and regulations, it's, you know, it's really difficult to know how it's all going to shake out in the end. Just want to touch a little bit on the FAME program. Finance Authority of Maine had a direct loan program to provide relief to businesses. It was only capped at $5 million for support. At this point in time, they're still taking applications, but it seems like the requests have exceeded the $5 million. So for those that have an application pending, it's really uncertain whether you'll get any funding or not. So that's sort of my nutshell in terms of some of the short-term planning strategies from the financial side. And I think Katie and Andrew will talk a little bit about some of the legal considerations.
So sure, thanks, David. Just to kind of put this in context, the information that David provided is, in my opinion, the foundation for putting together a short-term plan. You need to be able, and it really starts, in my view, with the 13-week cash projection. You really need to know how much money you have to spend, what you need to spend it on, and what you're going to do to solve any shortfalls. The 13-week projection is the key tool that will help you do that. It's not the type of document that you want to live with for your business long-term for long-term budgeting. It's not an income statement. It's not going to do what you need to do for permanent planning, but it will help you now. After that, David reviewed the immediate sources of cash that could be available for your business to help plug some of the holes, and we talked about some of the immediate operational changes that you could do, even picking up the pace on your billing. So now we're going to transition to the legal considerations for short-term companies in distress. And the first point is know what you need to spend and know how much money you're going to have to use. And the point I want to start with is that there are some legal and legal implications from a business standpoint here as well. You know, the first question we have is, how do you determine which disbursements are necessary and which disbursements can be deferred? Katie, what are some of the legal considerations that businesses and business owners who may have interests that are different from the business itself should be thinking about when determining what's actually necessary to pay?
Well, I think necessary is a kind of a loaded word that means different things to different people. And so, you know, what I would recommend is you start with that 13-week cash flow analysis, because that will give you a breakdown of your expenditures, and it should give you a list of everybody you're paying. And then you should mark who is necessary, not only because they're relationships that are important to you, You know, for example, you may work with, if you happen to be a restaurant who has figured out how to stay open right now, you may be working with like a farm, and it may be important for you to keep that relationship going and to keep purchasing during this time period from that farm so that the farm survives, so that you can continue that relationship. So that might be a necessary relationship for you. Your employees, you may have employees that could get another job if you stop paying them, and you want to make sure that they don't do that, that they don't go out and find some other place to go. And so that may be a necessary expense for you. And then after that, there are creditors that you may want to think about what their legal rights are, and decide that way if they should be on your priority list. For example, secured creditors, a creditor who has a mortgage on your property and could foreclose, call a default on the note and foreclose and take your property, or that's for a mortgage, or you may have a vehicle that is under sort of a similar legal relationship. If you can't work out a deferral on your payments or forbearance, those would be up on the priority list. If you have personal guarantees on certain debt with lenders, where if your business defaults on your payment obligations, which would give the lender a right to come after your personal assets, those might go up on the priority list. And so you should go and be very intentional and write out who comes first and what's the order. And then when you do that, you can see who's at the end, right? And make some decisions about how you're going to spend the money that you have.
So that one of the points that you made is to think about, and these are all really important. Who can take stuff from you if you don't pay? All right. Who can take your business assets, and who could take your home if you have a guarantee for the business loan that you've given? Sometimes those guarantees are then secured by people's residences. Understand that there's an interconnected web, and that when you have a lending relationship with a bank, a default under one of your loan documents is likely going to be a default under other documents. So there are larger implications to some of the decisions, but that also feeds into what do you actually say to the people that you can't pay? And these are your creditors and your lenders. I think it's important to keep in mind at the high level that we're all in this together. This is a very challenging time. We all have leaky boats or in the same leaky boat, and we're all bailing out the water in real time. And everybody wants you to succeed. And we all want everybody else to succeed. And that's the general mindset that I have right now with the discussions that I'm having with my clients and with their trading partners and their lenders. We're all in this together. So what do you say? That's the first thing. I think it's important to have candor when you talk to your trade creditors and to your lender, and to be upfront with them about the financial circumstances that your company is in. I think the short-term planning tools that we've talked about, again, especially the 13-week cash projection, is an important tool to educate yourself about your business's cash flow needs so that you can speak intelligently with your lender. Having an outside party, such as a CPA like David, review your projection and take a look at that will allow you to speak with greater credibility with a lender, for example, when you talk about your cash flow needs. Right now, in the immediate short term, lenders are giving away forbearance agreements essentially for free. So a forbearance agreement is an agreement by a lender to forbear or to take a break from enforcing rights that they have under loan documents with you or your business. And lenders are making these available to businesses and individuals. And so 90-day deferments of payment obligations, very easy to get right now with minimal or no documentation. Each bank is handling these differently. Some will simply extend the maturity date on the loan. Some will want a lump sum payment in 90 days. Some will want you to increase payments for a period of time after the deferment. Some banks will allow you to negotiate these terms. Some banks won't allow you to negotiate these terms due to the fact that they themselves are overwhelmed. Some banks in Maine are even using form forbearance agreements that their attorneys have drafted for them because they don't have the time to have their own professional staff supporting them. So, candor is important, not being greedy. So in my field, and maybe it's just me, but we have a lot of trite expressions. Pigs get fat and hogs get slaughtered. And what you want to do is ask for what you need to keep your company full and financially. But you don't want to be so greedy that people cut you off or don't believe that you have credibility when you're asking for the help that you need. And that's why it's important to use the tools that we're talking about for financial planning in order to have an economic justification for what you need in the immediate short term. This feeds into some of the intermediate planning that we're going to talk about a little bit later on in the program. But I want to just be clear that there's a thread to pull hard on the work that you can do today to figure out your short-term cash needs so that you have the information that we need for intermediate and long-term financial planning as well. So that's just something I want to highlight for you. And the documents that you would need, we're going to talk about these a little bit more, but again, the 13-week cash projection, a list of your business assumptions, and then other financial information. And you shouldn't be bashful about sharing this with vendors and lenders. So I know we have quite a bit to cover. We're about an hour in and everybody's being extremely patient. With this on the legal consideration of the short-term planning, Katie, is there anything else that you want to add on the short-term piece with documentation that folks should be gathering? And if not, okay, great. Dave, let's move on to the intermediate phase. And maybe if you could start by giving us some context for what time period you're talking about when you say intermediate.
Sure. Thank you. Before I move to the next slide, I got a question. What are the legal implications? Let's say that you don't have adequate capital to pay all of your vendors on a timely basis, and perhaps you're not paying them on a pro rata basis. Are there implications if you start paying them differently?
Yeah, there are. That's an important thing for people to understand. So there's a legal theory, and I'm going to try not to get too nerdy about it, but there's a zone of insolvency theory that would say that when a company enters a period of insolvency, the management of the company has a fiduciary duty to its creditors. Now, I haven't seen that legal theory tested here in Maine, but it's live and well in some other areas in the country. And so when you start preferring one creditor group over another, you may be, or if you start taking decisions to incur more debt without any real reasonable prospect of recovery, there are risks and there are significant legal pitfalls. Now, if your company were to file for bankruptcy in a liquidation phase at a later point in time, or even if you were trying to reorganize, the federal bankruptcy law requires a look back at transactions that were made in the 90 days before the company filed to determine whether some creditors got preferential treatment over others. And if the person who received the payment is what you call an insider, so an owner of the company or someone who is in control of the company, that look back period is 1 year. So if you have creditors who are putting undue pressure on you, they're exposing themselves to risk, and it's more of a risk for the people you're paying than for the company making the payments. But that's something that's out there. There are other buckets of law that could give the creditors of a company the ability to go after someone you transfer money to. That doesn't happen all that often, and this issue usually arises in a bankruptcy context. It's a good question, David.
Okay, great, thank you. So just want to switch a little bit into, what are some of the intermediate actions that business owners can take? And I think of intermediate between really the 3 months to 6 months period. And this is when you, again, access most of your liquidity, participating in some of the various programs that we've talked about. So now we're looking at, well, how can we look at the next phase in terms of, if I don't have the adequate liquidity, how can I access that? So some of the options here is entering into a sale leaseback of equipment. If you've got some equipment that is unencumbered, there are some finance companies out there, assuming you have equity in the equipment and so forth, you can essentially finance it, basically sell it and finance it back. So that will provide a liquidity event upon that transaction. Debt restructuring, and I know Andrew's going to talk a little bit about that, but changing the terms and conditions, we've talked about the deferral, refinancing, particularly with the interest rates being what they are, quite attractive. So refinancing can result in two things. One is pulling some equity out of either real estate or property for cash flow purposes, but also picking up some interest savings over the long term. Access to personal capital. So a lot of business owners that if there's only so much working capital and access to capital in the business, we have to then look personally if need be. So, you know, do business owners have a home equity line of credit? If you don't have one, then perhaps putting one in place in case you need it may be a prudent idea to start the process now. Perhaps there's some investments that may need to be liquidated, a retirement plan. There are some retirement plans that you can actually borrow against on a short period of time. So that may be some access to capital. If you have real estate equity, again, the home or a camp or other types of rental properties, that may be a good source of capital as well. So some of this is not immediate, could take 60 days, could take 90 days, but by starting the process, even if you don't end up using it, at least it's a good safety blanket in case you need that capital for ongoing operations. Also, it's a really good time to kind of reevaluate, you know, the current operations of your business. So during the slowdown, maybe paying attention to working on your business, not in your business, maybe a good chance to take a step back, take a breather, and really look at the operations, the processes, and the technology that your company is currently providing and offering and operating on. Other opportunities to improve efficiency, which is ultimately in the long term going to reduce costs. So really, really great opportunity to really, you know, spend some time, focus on the business if you have some slowdown period. So use that time wisely. I think that is one area that you can definitely recoup a lot of benefits from. Other options or other intermediate actions is, you know, we don't want to take our foot off the gas pedal when there's a lot of pent up demand and there's a delayment of services and goods. Once it does start to some level of normalcy, whatever that looks like, we want to be prepared, but we want to continue to make sure that we have work in the pipeline, that we're still active on the sales leads, even though maybe perhaps nothing is going to be firmed up or any sort of commitments, but at least that we're keeping the long view in mind, and that when we're ready to go, that we'll have a lot of sales and a lot of business ready. Scenario planning, again, we talked about the 13-week cash flow worksheet. That's really an important tool, but also in doing that, thinking in terms of best case scenarios or worst case scenarios. So perhaps when you do a 13-week forecast, you'll do maybe multiple versions. One is best case, one is worst case scenario. And again, you know, if you evaluate the worst case scenarios, you'll be better prepared. So if you're finding that in those worst case scenarios, you have significant working capital deficits, how do you cope with them? How do you cope with those uncertainties? So you really want to start preparing for those action plans based on those various case scenarios. And so many organizations, you know, are so focused on dealing with the COVID issues, dealing with the economy, dealing with these, you know, personnel challenges, that there are some parts of your business that maybe is not getting the attention or focus that it needs to, particularly in the cybersecurity. So when companies are vulnerable and they have their sort of their eye off the road, then this really opens up to more cyber attack. So it's important to, you know, make sure that you talk to the IT department, or if you're out sourcing, making sure that you're not exposed, particularly with remote working. You got a lot of employees that work remotely. Is it secured? You know, how you're accessing, you know, your company's technology. Is it secured? So there could be a lot of leaks there. So you really want to make sure you protect yourself there. And like anything else, right? When there's a loss of focus, that opens up to more opportunities for theft and fraud, both in the inside, internally, as well as externally. So it's just really important that being vulnerable could potentially lead to significant impact to cash flow and to your operations. So it's important. So next, I just want to talk about a couple of some of the tax provisions that were passed to help businesses in their operations and in their cash flow. And one of the changes that took place as part of the CARES Act is that now net operating losses for 18 and 19 and 20 can be carried back to 5 years, where previously on the Tax Cuts and Jobs Act, that particular provision was changed so you could only carry forward the losses, not carry back. So now you have an opportunity that if you've incurred losses in those years, you can go back and claim some tax refunds. So there's some possible planning opportunities there. And keep in mind that, you know, for 20, even though a company may show income on their books because of the debt forgiveness, if that's tax-free, even though you may be looking like you have a profitable year, but on tax purposes, it could very well be a lost year. So you want to make sure that if you do have a lost year, you want to file quickly and make sure you process those net operating loss carryback claims. Another technical correction was a qualified improvement property. So for certain types of improvements that are essentially made to an internal non-residential building that are non-structural in nature, particularly we see this a lot in retail type businesses, that for those improvements that are made in 18, 19, and 20, that you'll be able to elect to write those off in 1 year, essentially take bonus depreciation on that. So that could very well put a company into a loss position with all that accelerated depreciation, which then could generate a net operating loss, which you can then carry back. So the important piece here is there's really some opportunities to amend returns, claim refunds. Make sure you talk with your accountant to see if any of these provisions apply to you and how you best comply with them, and to try to grab as much money as you possibly can in back years. Other changes that were made as part of the CARES Act is there's now a payroll tax deferral, where essentially businesses can defer the employer's portion only of Social Security taxes between now and the end of the year. And what is deferred by the end of the year, 50% would be paid at the end of 21, and the other 50% would be paid at the end of the year 2022. So there's allows for a bit of a float for payment of those those employer taxes. Unfortunately, no deferral is available if you receive any PPP loan forgiveness. So for most companies that are getting at least $1 or more forgiveness, that particular payroll tax deferral is not available, unfortunately. Another change that was made was the employee retention credit. So if a particular business was closed or suspended due to due to requirement by the government, then what you can do is you can actually claim an employer tax credit, which is 50% up to $10,000 of wages for this year. So essentially you can get up to a $5,000 tax credit. For those that are participating in the payroll protection program, you're not eligible for that particular credit. But for those that unfortunately weren't able to be participating in that program, then that credit may be worthwhile if your intent is to retain your employees. If you're in a situation where you can't afford to retain them, then obviously that credit is not available. But it's certainly something to consider. Given your situation, it may be just another tool in your toolbox that you could use to help with cash flow. So those are sort of some of the intermediate action steps that business owners can take. And perhaps Katie and Andrew, maybe you could talk about some of the legal considerations in the intermediate time.
Sure, we're happy to do that. It's very helpful to have that context, David. Thanks so much. When you are in a period of distress and you need to increase liquidity, one of the big questions is, should I borrow more money? And there are a number of legal considerations to think about in that. Katie, why don't you run us through some of those issues that business owners should be thinking about right now?
So I think that the advice that I would give to business owners who are thinking about borrowing money doesn't change a whole lot than the advice that I would give before the crisis, other than to take advantage of as much free money, which never exists otherwise, as possible. But one of the first steps, I think, is to set some boundaries for yourself. You know, decide what assets you can put at risk and which you can't, and do whatever you need to do to make sure that you stick to those limits. So, for example, if you have to give personal guarantees to get some of this money, and you know you're putting your house on the line is a hard limit for you, then you should not take money that requires you to give a guarantee that would put your house at risk. If you have accounts set aside for things like educational expenses for your children, then using that money, if those are monies that you want to make sure you protect, then using those monies is not something that you should do. That should be one of your limits. So I'm just trying to follow along on the slide. I think we're a little bit off. So that's the first step that I would say, is to come up with your boundaries before you decide which of these programs that you're going to take advantage of. The second thing that I would say is do as much without borrowing as you possibly can, right? So look at the operational changes that you can make, look at the tax options that are available to you, amending prior year returns, claiming credits, and get as far as you can that way. And then cover the shortfalls with some of these programs, if they're available, that have the most advantageous terms. Andrew, what about you? What would you say?
No, I think that those are the right points. I mean, one of the things that I've heard you talk about often is, protecting the value in your business for, new startup costs if you need to. And I think that that's a really important point. And then again, are there business decisions that you're making now with the borrowing that you're doing that are going to have a long-term impact to you as the business owner personally, like loan guarantees? But generally, the borrowing consideration should be the same whether you're in a pre-COVID situation versus now, except that there's grant money, and you need to be thinking through the long-term consequence of taking on new money today. We're going to talk about that a little bit more in the long-term phase. We're going to transition to long-term actions, but look at the financial modeling tools that you have and ask yourself, why are you taking the borrowing, right? Does this borrowing fit into a broader plan for you, your business, and your personal life? How does it all fit together? I think that's the key question. So get your financial modeling tools in place so that you can answer that question for yourself, and then figure out what you're doing today and whether it makes good business sense. I think right now we're in the first 90-day time period, and everybody should try to get as much free money as they can. I don't mean that in an improper way, but we have extreme uncertainty. And what I think businesses need to do is bring in cash today, increase liquidity, as David was suggesting, so that they can lengthen the runway and get themselves breathing room for the next 60 to 90 days so that they can put together a plan for the next 180 days. And in the 60 to 90 day window, you should be mapping out your legal strategy and your business strategy to make it through the next 180 days. And it's over that time period that you'll be able to fit together the pieces to examine what you should do in the long term. So that would be the other thing that I would add on the intermediate financial planning.
So as we head into a discussion of the long-term plan, just so that David and Andrew are aware, we have quite a few questions. So for the attendees, we're going to kind of steam through this last section and give you an idea of what's coming up so that we can answer as much of your questions as possible.
Great. And hopefully the slides will obey. For whatever reason, I think we have another little virus in our technology here. Thank you for everyone's patience with this. Other long-term actions, and kind of go through them briefly. We talked a little bit about, do we bring employees back even if they're not productive? The biggest fear a lot of companies have is, will they be available when this thing turns? So there's a bit of a gamble here, and I think it really is going to vary on a case-by-case basis, and really weighing in debt forgiveness versus access to working capital. Because what's going to happen is this, with all this pent-up demand, and once the business ramps up, we have another set of challenges on us. One is the liquidity. For a lot of business, got to build up inventory, got to build up work in process, got to build up your receivables, and that may not start turning into cash on 30 days or 60 days or perhaps 90 days. So how are you going to be able to cash flow yourself during the period of growth? As we all know, times of growth is also times where liquidity is sometimes hampered. So we want to make sure that we've got the liquidity, make sure that we have the resources, the personnel, the technology, the capacity to deal with this business. It's great being busy, but it's also being overly busy when things start to crack in the process. So how prepared are you, and are you ready when this thing does start to turn? And will your business model change? It's really kind of fascinating with people working remotely now. Is that going to impact what's happening to our businesses? I know there's a lot of websites that talk about curbside delivery, non-contact deliveries, and this was not in our regular vocabulary 4 weeks ago. So it's really going to be interesting to see what the new normal is when everything kind of go back into some sort of normal fashion. But I think it's important that businesses look at what's happening, and do they need to change? Do they need to change how they deliver products or services? So it's really kind of an interesting question that a lot of businesses are going to be faced in, is how is the business model going to have to adapt, possibly? So these are things that business owners really need to think about. Identify points of failure. I think as any situation where we have challenges, oftentimes there are opportunities that come out of it. And what are the things that business owners have learned from this? What has worked well? What hasn't worked well? Perhaps we find that certain personnel, maybe they weren't in the right position. Maybe, they don't have the skill set to handle these sort of types of challenging times. So what kind of corrective actions can business owners take? So it's really a good opportunity to take a look and say, okay, these are the things that didn't work quite well. How can we improve it? And time to revisit strategic and tabled initiatives. We all have the to-do list, and maybe it's a good opportunity to take back that to-do list and work on a strategic plan. And knowing what we know now, what we learned through this process, and perhaps how our business needs to be adapted, how do we look at a strategic plan and make those most important changes? And part of that comes with creating a disaster recovery plan and a continuity plan, which really go hand in hand. And we can't forget that forecasting will continue to be critical. And for some businesses, it could be 3 months, could be 6 months, or it could be a year. For some companies, it could be a quick recovery. For other types of businesses, it could be a year or 2 years from now, particularly if this is going to be accompanied by a long-time recession. We really need to be prepared and really making sure that we're disciplined in our approach to managing our cash flow. And all these plans will have an impact to cash flow. May not necessarily be today or tomorrow, but certainly over the long haul, what we do now and how we handle the situation is going to have a long-term impact. So I know I went through those relatively quick in light of time and some of the questions and answers, or perhaps Andrew, you can talk about some of the long-term considerations.
I'd be happy to do that. And I think I want to come back to a point that Katie made, and then we know that there are a lot of questions that you all have, and we want to get to them quickly. So I'm going to power through this material a little bit quick to make sure that we're leaving enough time for the really important questions that you all have. From a legal standpoint and a business standpoint, long term, you need to figure out, well, what am I going to do if simple cash management and short operational changes don't weather the storm? And we can really move to the next slide, David, if that's possible. But it's all based on this foundational concept of identifying your breakpoint early. And I think that's a point that Katie said. And you need to know today when you're done. And you may not have that down to a certainty, but if you don't have a line, you can't decide what to do when you get close to that line. And that's a really important point that I want to make. So to just quickly, one of the options that you have is to talk to your lenders or anyone you owe substantial amounts of money to, and on a totally voluntary, totally consensual basis, retool the loan and rework the loan. And that can mean changing the payment terms, changing the interest rate, changing the maturity date. You should have those discussions, and you can have them directly with your bank. You can have them directly with your trading partners. This is where the work that you've done on your projections and your modeling of operational changes will help you be credible in those discussions. Again, we're all in this together. We've all got challenges that we're dealing with from a business standpoint. And I think you're going to find a receptive ear for these issues. But you need to be able to speak intelligently from a point of authority about your business and knowing what your business needs to succeed and answering the question for yourself, can my business succeed? And if you come to a point where your business can't succeed, and you know that, or you come to a point where maybe it could succeed, but you're at your breaking point, then you really need to think about how to close the business in the least harmful way. And that means not just thinking about what to do with a wind down, but how to make sure that if you're the business owner, you're protecting yourself to the extent that you have guarantee liability, or that you have other lending relationships with the same bank. These can be complicated situations, and there are inevitably going to be some wind downs and closures and some retoolings. Before we even get there, though, as far as making a decision about whether you should wind down or whether you should close, you can also evaluate permanent operational changes. And so David touched on that a little bit. I don't want to spend a lot of time on that, but you have an opportunity to think about your business holistically and what it's going to look like going forward. And not only do you have the opportunity, you likely have to. If you're a restaurant, we could find that there's a period of time where you can have fewer people inside the building. The last point before we get to these final thoughts are that there are also court proceedings that you can use to restructure your company. So in the CARES Act, which is the major coronavirus stimulus legislation, Congress has made it easier for companies to take advantage of streamlined processes to reorganize in Chapter 11. And they've raised the debt limit so that now if you have up to $7.5 million in fixed debts, stuff that's not contingent, you can use a streamlined Chapter 11 process that is designed to keep you as the business owner in control during the case and in control after the case. And it can allow the business owner to retain ownership of the company even if claims of general unsecured creditors are not paid in full. All the details on that process are outlined in an article at the link that was in Main Biz earlier this week. And it's on our website if you want more information. So I'll leave that there so that I don't take up time and so that we can get to the questions. But that's another tool that's in the toolbox, is a formal debt restructuring proceeding. And unfortunately, I do think that we're likely to see some of those. But from my perspective, that's also an opportunity for a business to use a court case to get rid of contracts that aren't profitable and to right size your balance sheet, because you can actually reduce the amount of debt on your company's balance sheet, including reducing the amount of your mortgage debt if the value of your company's assets is now less than the amount of debt that you owe. So you can have your company emerge a little bit leaner and meaner and stronger. So the final thought that we have on the next slide is essentially that, the road to economic recovery is going to be long, but your community and we all want you to succeed, and there are professionals who are there who can help. I know we have a number of questions that have built up. What I'm going to do at this point, because I think it might be helpful, is I'm going to take the slides down and we'll just sit and answer some questions for you guys for a few minutes at this point in time. So with that, Katie, do you have some of the questions queued up that we've been monitoring?
Yep, and I'm going to generalize a little bit, and if we have time, maybe get into some of the super particular questions, but I think everybody is trying to think of ways to maximize the payroll costs portion of the forgivable calculation for the payroll protection program. David, do you have any specific ways that you've been talking to clients about maximizing the way that they can spend money on payroll costs?
So again, we're still waiting for some final regulations. So, one of the things we're suggesting is, obviously make sure you have a good audit trail. You're capturing all your payroll costs, all those costs that are eligible for reimbursement, the rent, the utilities. So it is really important. And, the guidance, again, without further final regulations, we're seeing certainly some opportunities to perhaps provide some bonuses during that 8-week period to try to maximize the amount. Try to throw in, everything, including the kitchen sink, so to speak, into that 8-week period. And again, let's not make that determination whether or not it's eligible or not eligible for forgiveness. So track it, include it. Once we get further guidance and regulations, then we'll know what's forgivable or not. But whatever is eligible, or whatever they suggest what the proceeds could be used for, capture it, record it, and I think that's the most important thing to do. And again, there's a lot of question in terms of, can I prepay? does it have to be paid, or how about if it's accrued during the period? Is that eligible? So when you get to the 8-week period, obviously the best course of action is to pay as much as you can, even though it may perhaps be a prepayment. Perhaps it may be an advanced contribution to a retirement plan or any sort of bonus arrangements of that type. Do it for the 8-week period, and we'll sort out later. Again, I would rather ask for forgiveness than permission, because once those costs are outside that 8-week period, it may be very difficult to claw back. So that's what we're kind of recommending in absence of any final regulations, which I suspect will be forthcoming quite shortly.
And so the thinking there would be that better to spend it now and fix a problem later, and the type of problem people are likely to have, in your view, is just simply altering the amount that's forgivable. That's the way folks on the accounting side are looking at it.
Yeah, I really think so. Now, keep in mind that, if you start bonusing people out during the 8-week period, and if you analyze it and their compensation, let's say it's over $100,000, it's not going to work, because any amount excess of $100,000 on an annualized basis is not eligible for forgiveness. So, you fix one problem, you sort of create another. So for some people, a bonus may be appropriate, or it may be subject to forgiveness, whereas other bonuses may not be. So the tool that I mentioned earlier takes that into account. So in that tool that's available on our website, there's actually a column that you can include bonuses, and that'll show your impact to the debt forgiveness amount as well. But again, that could change, based on further regulations. I think the government's smart enough to recognize that there's going to be a lot of businesses that are going to try to maximize the debt forgiveness. As I said before, for some companies, it may not be maximizing debt forgiveness. It may be the opposite. It may be perhaps defer some expenses so that they have more available to use as a working capital loan. So it could be very different in terms of the strategy.
Right. I mean, the terms of the loan are great. No payments for 6 months, 1% for 2-year maturity. I mean, that's not going to happen again anytime soon without any collateral and minimal application process. So what about health insurance premiums? Most employers who offer health benefits split the cost with their employees. Have you spoken to anybody about picking up the employer or the employee paid cost as a way to reduce that expense?
We've had a number of conversations regarding having employees giving an 8-week holiday, where essentially the company would pick up 100% of the employer contributions. I would certainly try that. Will it get kicked out of the regulations? If the regulations come back and say that you can't do anything that historically you haven't done, then again, that may get kicked back. So the exposure there is the employee may end up paying 8 weeks of those employee contributions without getting reimbursed. Is that a risk they want to take? I see clients go both ways. Some are willing to take the risk and others aren't.
Right.
Again, there's nothing definitive on that.
Yeah, I think that the ultimate message right now is there's a lot of opinions being offered out there about unique strategies people can take to increase those payroll costs, hit the 75% threshold. But until we have the actual guidance from the SBA,
right,
you're not assured, right? Until we know how they're going to calculate exactly what your forgivable portion is going to be and how that application process is going to work.
Right.
It's all just a risk a little bit.
We've been posed with so many questions, and it's like a broken record. We don't know for certain, and that's just the reality of it. Perfect example, utilities. I handle a lot of contractors. All the utility costs that are borne by the individual job sites, are those includable? I don't think that's the intent, but again, hasn't been defined. So be prepared, track it, accumulate it. It's the best you can do, so you can at least be prepared. So when you go into that process of providing documentation, you'll be prepared. And it's really important to make sure that as companies are expending the money, have all your documents, be contemporaneously prepared, so that you don't have to reconstruct history or a constructive point in time. So scan all the documents, scan all the payroll records, scan all the bills, scan all the rental agreements, get it ready and get it queued up.
How does the payroll tax deferral and credits work around the PPP loan? Can businesses defer those payroll taxes or take credits for payroll that they've been paying out in advance of receiving the money and after receiving the money, just not during it? Or how does that work?
So it's kind of interesting. So with the employer payroll tax deferral, which the employer's share of the Social Security tax only, the 6.2%, not the Medicare portion, that essentially you can defer whatever you've incurred during this calendar year, you can defer it over a 2-year period. However, if you receive any debt forgiveness, you're not eligible for the program. So if you think about it for a moment, that if someone's currently deferring those payroll taxes and they've been, they've gotten the loan proceeds to the PP program, and let's say that doesn't get forgiven for another 3 months, what happens? You have to pay back that employer tax deferral upon forgiveness. Can you still keep that deferral? Worst case scenario, are you prevented from being eligible for the debt forgiveness because you're participating in the payroll tax deferral incentive? So these are a lot of questions that run through my head every night as I try to lay down to sleep, and these things keep kind of circling back. And unfortunately, there's just a lot of unknown. I don't think the SBA is going to take a strong hand to some of this, but you never know.
So
You have scary dreams, David.
Well, so that ties into kind of a fundamental message that I want to make sure that business owners and people participating here is that we have a period of instability and there are a lot of unknowns. We don't know whether PPP will be funded again. We have questions about some of the costs that may be permissible as a payroll expense under PPP when you're trying to maximize forgiveness. We don't know whether the economic injury disaster loans will be increased in terms of the appropriations. There's current work on what I would call COVID-4, a further stimulus package. These are all things that are happening. And so in a period of instability and unknowns, the question that I have for you as business owners really is, what can you do to get as many known items on the table? So I like to boat, and I think about having a nautical chart out in Casco Bay. If I don't know where the rocks and the islands are, I'm just completely adrift. And right now, there are a lot of rocks and islands that we can't see, and it's foggy. What can you do to start to fill in the gaps? And I'm a broken record, but I think step one is your 13-week cash projection. So this, I think, feeds into a final slide a final set of thoughts that I think I would be good to get from all of the panelists. But before I turn to David with that, the thing that I would always recommend businesses starting with is get a handle on the money coming in and the money going out. And it's that I would start with that 13-week cash projection as a short-term planning tool, because you can't make good decisions from a short-term standpoint without reliable information. And if you can't make good short-term decisions, you can't make good long-term decisions about your business and its health and the long-term prospects for it. So with that, David, are there any key takeaways that you want to make sure that clients and business owners have for the program?
Yeah, I think, again, cash management, having those cash management tools available to you, I think is critically important. I know we said that like a broken record, but it's worth repeating. I've mentioned that I think it's a great opportunity for a lot of business owners during the slowdown is take a step back, reassess your operations, reassess your business model, revisit your strategic plan, business continuity, disaster recovery plans. It's a great opportunity to really come out of this stronger than you were before. And I think the third part is reach out to your advisors, your accountant, your attorney, your banker, perhaps your consultant, perhaps your peers, and really rely on them, reach out to them and see what they're seeing. Because I think if we share our ideas, share our best practices, we're all going to come out of this better ahead. But those resources are available to business owners. Use them. And I think that that is just so important.
Katie, do you have any key takeaways that you would suggest for business owners or watching or clients watching the program?
Yeah, I mean, I think we're at the point now where we're all emotionally exhausted about trying to deal with this and trying to process the information and make some choices. And so my three key takeaways are more about that. And the first one is to develop a holistic plan. Use your tools available to you and your advisors, but draft a plan for yourself, write it down, and then you can let go of a little bit of the uncertainty and you have a roadmap for how you're going to proceed. And that will also help you assess the sort of resources that are available to you and how they fit into your overall long-term plan and recovery from any of the effects that you're feeling right now. Fitting in with that, the second point is define your boundaries and keep them. Come up with a strategy for how you're going to do that. I know it's tempting to break your boundaries when you've set them, but don't destroy any like emotional relief that you get by doing that, right? So set those and keep them. And the third one is do as much on your own as you can without relying on programs. They're uncertain. We don't know all the terms right now, and they keep being exhausted. So if you've received money under them, that's great. But if you're still looking for help, really dig into your business and see what you can do with the tools that you have available to you on your own before you rely on any money from the government.
Well, thanks. Look, those are the great points. I don't have anything that the two of you haven't already said, except to say, Katie, that sounds like good life advice for people too, with set boundaries. I think a lot of times our businesses and our personal lives, really intersect with one another, especially for small businesses in Maine. You're all in, not just economically with personal guarantees that may be secured by a mortgage on your house. You're all in emotionally too. Right? It becomes our life. We spend 8 hours plus a day working, right? It's a huge part of what we do. But like I said earlier, your community wants you to succeed. Your government wants you to succeed, and we do too. We will post a copy of this video on our firm's website with the slide deck. We will also post or make it link through so that you can get a copy of a sample 13-week cash projection, which is those are the words I've probably said the most on this program, which should tell you how important I think it is. And we're going to make the video available to David and his firm so that if they're able to, they can post it on their firm as well. And, the resources are there for you. And if there's anything further that you need, all the contact information's there, and don't hesitate to be in touch. We really appreciate your time. You've hung in there for a 90-minute program. And we appreciate your interest and look forward to connecting with you in the future, hopefully in the real world and not just online through Zoom. Thank you.
Good luck, everyone.
Thank you, everybody. Thank you.